Bill Ackman wants the Federal Reserve to shock and awe the stock market, what that potentially means, and what can you even consider doing about it. I'll talk about that as well as the chart that really has me concerned in this video. If this is your first time tuning in, my name is Daniel. You're watching Unrivaled Investing, a no-hype mission-focused channel trying to find you exceptional companies and unrivaled investments. In full disclosure, this is not financial advice. And so let's dive right into the latest post from billionaire and multi-billion-dollar hedge fund manager Bill Ackman, where he recently called out how the Federal Reserve should get ahead of inflation by raising rates faster than many expect. Instead of raising by just 0.25% in March, as is widely expected, broadly expected to raise about 3 or 4 times in 2022, the Federal Reserve should get ahead of it. They're lacking the credibility to fight inflation, and they're continuing to lose it, given the narrative over the last few months about transitory and constantly behind the ball. Let's get in front of it for once. Let's actually show that they can do it. And one way to do it is to raise, instead of by 25 basis points or 0.25% in March, they should jump. This is what he's suggesting. They should jump to 0.5% surprise move, in his words, to shock and awe the market, which would demonstrate its resolve, the Federal Reserve's resolve to fight inflation. Okay, so what do I think this means? I think it's worthwhile to have some context on Bill Ackman, where I think he's one to consider his voice, the ability to speak to tens of thousands, if not millions of investors, and potentially even influence the market. He would argue, hey, I don't know what you're talking about. But the reality is, in March 2020, when it was becoming increasingly aware that the pandemic would cause real trouble for the economy and a lot of stocks, he came on, he was on CNBC and he nearly sounded like he was crying, and the stock market fell like 4% that day. Now, he later, got on and said, the idea that my appearance pushed the market down an additional 4% that day is absurd, which, maybe it's just a little bit posturing, but, it is worth calling out that at that time, Ackman warned that hotel operator Hilton Worldwide was going to zero, along with every other hotel company in the world. And he also talked about how he was also aggressively buying that stock, Hilton, as well, and he'd been buying all the way down. So, I mean, his view was like, well, wait a second, this is just, people are misreading it. They should have been taking this as an extremely bullish angle. But generally, when someone says, I'm buying something that I think is going to zero, that's not quite the case. So everyone views this as him sort of manipulating. That's the way it's often perceived on Wall Street. Whether or not you want to take Bill Ackman's perspective, that's up to you. But it's easy to see, if you come on CNBC and it just sounds like, you're so emotional that the economy, it's going to bring down every company in the world and the economy. This is hell is coming, is what he said. Like, if you're going to be saying things like that, then even while you're buying, I think it has a lot of people sort of doesn't sit well with many investors. I think even one former fund manager, Mike Novogratz, he was talking about how they should get, I think that same day he was like, they should get Bill Ackman off CNBC before people start jumping off of bridges or buildings. And so what do I think this all means? So looking at Bill Ackman's post from this angle, recognizing that he could be self-serving, and using his voice to get that angle, I suspect he's considering a few different trades here. So not necessarily that he's done it let's say last year, but maybe he's actively doing it now, or something that he's considering doing, such as shorting the market or buying puts. If you're saying shock and awe the market, that means you're expecting the market to go down significantly. I would suspect, this idea of, oh man, the Federal Reserve is moving faster than I expect, or he's buying interest rate derivatives. Some talk about swaps that benefit from interest rate hikes faster than the market expects. So effectively, these are really the second thing that I mentioned. Shorting the market, that's fairly straightforward, or buying puts, that's fairly straightforward. And certainly he's accustomed to doing it, and he had done it. And his puts had made money when he did that March 2020 call. But these types of bets, this is more like pretty much just straight gambling, where you're saying, hey, I think the Federal Reserve will raise by this amount before this date, and it's sort of driven by a payoff type structure. So it's possible he's considering either. This is really just conjecture on my part, just given his past behavior of saying, hey, here's the situation, and meanwhile he's actively making a bet. So despite this posturing, I'd argue this really isn't the chart that got my attention this past week. And what really got my attention is this chart. This isn't what, in my mind, in the immediate term, can cause the market to fall fast and furiously. What really has my attention is this one, which is from Yardini.com, so you can check that out. And what's really alarming, in my opinion, is the explosion in margin debt. And you can see how there's been a nearly $500 billion increase. It looks like in 2019 to today, from around, it looks like around 400, 500 billion to around 900. So this huge, it just went parabolic in terms of the amount of margin debt that investors were willing to consider with the market. So that has just been an explosion in debt. And in all honesty, let's take a little history lesson here. I mean, you see this explosion, this year-over-year change, billions of dollars, and you see these types of explosions happen near the peaks in the market. I mean, you saw the exact same thing happen, before the market turned. You saw it again before the great financial crisis. You saw it again with the dot-com bubble, once again getting bigger and bigger each time, the size of it. And so this is cause for great concern. Now, to keep in mind, this is a yearly change. So this means it's still getting bigger. It's just not growing at the same rate. So previously it was growing really fast, nearly 350 billion year over year. Now it's only at 200 billion year over year. So it's still enough to funnel the bubble. But once you start having that sort of change in psychology where people aren't willing just to go crazy and it just slowly starts going down, then it really gets concerned is, could it start dropping precipitously to start going into that negative territory? And that's really when the market starts to revolt, because that's when you start having this quick contraction where you start having liquidation, margin calls, and that's the fast and furious that really gets the market going. So the shock and awe of a federal rate policy change, that could start driving the behavior that has this. It is alarming to see, okay, there's a good chance sentiment has peaked and that, now it's just about, I wonder how long it's going to take. And that's what I see when I look at charts like this. These types of things do suggest, okay, these charts do show sentiment. And you could say, well, wait a second, Daniel, what about these periods, from 2012 and 2016, and how about 2018, 2019? It's not like the market collapsed then, but you didn't have as much of a dramatic run up. And I'd argue during this time you had Federal Reserve support for the most part, largely with quantitative easing, very friendly Federal Reserve. That's the exact opposite of where we are now in terms of the Federal Reserve saying, look, we got to tighten, and you have investors pushing for a shock and awe campaign to combat inflation. Now, some might argue that it's not that big of a deal. Say, Daniel, you're actually missing a big point, which is that, once again, a chart from Yardini.com, where you should compare the amount of debt to, let's say, the securities that they can offset. And here it is, you'd go, well, wait a second, as a percentage of the Wilshire 5000, it's only like 2%, as a percentage of the Wilshire 5000, the amount of margin debt outstanding. And so I have a couple of thoughts here. One is that if you go back to, let's say, the mid-90s, what you're really talking about is that it's 50% higher as a percentage basis. And so there's still dramatic downside in terms of, if sentiment changes and investors say, oh my goodness, I don't want to have this much debt relative to the securities outstanding. That's one aspect. And the other aspect is, yes, I agree on an absolute, percentage. On looking at this on a percentage basis, you could say, well, it's not the highs that it was as a percentage, that it was back in 2007 or, back in 2000. But I think it's really a gauge of human behavior, and its changes show that. Like, oh, this is the change. This shows you, oh, this is, investors are really gung-ho and they're really, let's lever up as fast as we can as securities. But now it's starting to, no, okay, I'll borrow a little, maybe not. Oh, okay, now I got to sell a lot. And that's the concern, is that, the recent changes is really a gauge of the change in sentiment. And sentiment can play a really big role in the stock market. Not only do you have fundamentals drive the market, but sentiment plays a huge role, especially because there are so many companies today that trade at these lofty multiples, price to sales multiples, and they're unprofitable. And if you have a change in sentiment where folks say, hey, I need to get a discount because of that. And right now, for the most part, I see companies getting full credit despite operating nowhere near their future potential margins. And companies are given full credit. If sentiment changes, you could see a huge, downdraft in terms of valuation. And that's sort of how all this feeds on it. Maybe it starts with that, shock and awe that Bill Ackman talks about. Oh, okay, then it becomes a little more costly to have that margin debt because rates go up a little bit. Okay, now margin debt really starts changing. Maybe it really starts selling off the margin debt, because of your concerns there. So these are the charts that sort of get my interest. These are the data points that get my interest from the macro perspective. Meanwhile, I'll continue to focus on trying to find those potential multi-baggers by going to unrivaledinvesting.com. Click join the journey if you're interested. If you enjoyed this video, please make a point of hitting that thumbs up and hit that subscribe button. Thanks so much for tuning in. I'd love to hear your feedback, by the way, if you have a different take on either margin debt or Bill Ackman. If you think, oh no, Bill Ackman's not positioning his portfolio, or what you think Bill Ackman potentially is doing with his portfolio, if you think there's a different angle that he's doing other than potentially shorting or buying, effectively derivatives on interest rates moving higher, I'd love to hear it. Thanks so much for tuning in.